From New York City for our viewers worldwide, I'm Matt Miller. After another fresh record high for the S&P 500 yesterday, it's all eyes on Nvidia after the bell. Futures are mixed, and the countdown to the open starts right now. Coming up, stocks sitting at fresh record highs ahead of Nvidia's pivotal earnings report. Retailers deliver a mixed bag as Target misses the mark, and traders trimming their rate cut bets as the Fed Speak tour continues. We begin, though, with the big issue, counting down to the main event.
Nvidia, the bar is high, expectations are high, but I think they will beat and race again. We think 2024 will be another banner year. We think data center revenues for them in the 90 billion plus. So they continue to execute well. We think that 90 billion will grow almost 4x in the next 5 years to almost 280 billion in data center revenues by 2027.
Joining us now is Mandeep Singh of Bloomberg Intelligence for the all-important earnings report. Mandeep, Nvidia earnings come out after the bell. What are your expectations? Because a miss could hurt this market.
I mean, Vijay was talking about 90 billion plus in data center revenue. I would argue if they guide for next quarter below 25 billion in data center revenue, the knee-jerk reaction would probably be negative. I mean, look, this company clearly is exposed to the biggest secular trend out there, and they have the best IP. The question is around the durability of the top-line growth. And I would argue, you know, they have new architecture coming, the Blackwell architecture. But when you look at the traditional data center spend, it used to be 2-year cycles. Now we are talking about less than 1-year cycle. And data centers don't refresh their chips that quickly. So it'll be interesting to see what they say around the training and the inferencing demand for data centers.
There's an issue in the automotive world, Mandeep, when, for example, Porsche puts out a new 911 or teases that one is coming, fewer people want to buy the current model. And that issue seems to be affecting these highly complex chips as well. Is it a concern to you if, for example, AWS says, we don't want any more of the Hopper, we're waiting for Blackwell?
I mean, it clearly is a risk, but so far the market has been supply constrained, and that works in NVIDIA's favor. I mean, I just mentioned they have the best IP, and everyone wants NVIDIA chips. There is no competition on the training side. On the inferencing side, they mentioned they have 40% exposure. It will be interesting to get an update on that data point, because when you're doing inferencing, you could use AMD chips. You could use, your Apple smartphone or Microsoft launching AI PCs. So inferencing can be done at multiple places, and it'll be interesting to see what sort of exposure NVIDIA has on that side.
We learn a lot about other big companies like Apple, for example, when we get reports from smaller suppliers that are chip makers or screen makers. Do you expect to learn more about the market at large when you look at NVIDIA's numbers tonight?
Absolutely. I mean, look, when you look at the NVIDIA's market cap, it almost, it exceeds the entire market cap of all the semis combined. So clearly, there are a lot of expectations, and NVIDIA is linked to the supply chain, whether it's TSMC or, for that matter, even ASML, how many kind of equipments they're going to ship. So clearly, there is a lot of linkage when it comes to the growth of generative AI and what it means, but NVIDIA clearly has to make sure it can sustain its pricing and unit growth, which is what has driven these triple-digit growth numbers for the last few quarters.
All right, Mandeep, thanks very much. Mandeep Singh covers NVIDIA for us from Bloomberg Intelligence. Now let's continue this conversation with investor Matt Orton of Raymond James. Joins us. Matt, thanks so much for coming to the studio this morning. I mean, it's a big day, right, for this bull market. It all comes down to one stock. Someone asked me yesterday, does this remind you of 2000?
Matt, it's great to join you. And I think you can draw some analogs to 2000. I think this is a very different market. Many questions that I get from clients right now are, how else can I get exposure to this theme without just owning Nvidia? Because we've been so focused on one single stock. And there are so many opportunities beneath the surface of this market that are finally starting to work. You're seeing earnings breadth expand. And really what I've been talking to clients about is artificial intelligence 2.0. Where else is the CapEx going to be deployed and spent going forward? In order to power these chips that Nvidia has, you need coolants, you need heating solutions. So that's electronic equipment companies within industrial. So that's just one example of how broad this can go. And I think if you get some weakness on Nvidia, I think it's an opportunity to add to your exposure in this market.
Yeah, I mean, we were just talking with Mandeep about this. If you have a Bloomberg terminal, the SPLC function shows you the whole supply chain on all sides, and it's obviously a picture of the biggest, most important companies in tech. Who else does this affect, you think, besides just the chip makers?
So when you look outside of the chip makers, you've also got the hardware companies, so your Cisco's of the world. They have been benefiting strongly from some of these trends, but go out further. And I think even outside of just the supply chain that you talked about, it's who are the ancillary beneficiaries of this. So in order to realize the demand of this data center build out, you've got to have enough power to power all of these data centers. And so utilities have been on fire lately, largely because you have electric utilities that need to make massive investments. And I spent last week, I met with some congressional members of states from Georgia, Florida, Texas, and the message I took away from that was trillions of dollars are going to be invested in building out the grid to realize where we need to go. What else do you need to build out the grid? Copper. Maybe you look at some of the high-quality miners since they've cleaned up their balance sheet over the past few years. So you can keep going down the list, and there's plenty of parts of this market that have only started to move in response to this AI theme.
Yeah, I wonder, you know, when we were looking at the internet back in 2000, you may have expected it to have a huge effect 20 years later on Target and Walmart, but you might not have expected car makers to care about the World Wide Web, right? How important is AI to other sectors than tech in this market?
Oh, it's very, very important. When you look at what is important for driving the earnings growth we've seen, it's been margins. Margins sit near record highs right now, and it's because companies have been able to integrate technology into their operations. And a big way to drive margin growth going forward, with wage inflation being the challenge that it is integrating artificial intelligence. So when you look at Walmart, when you look at even customer service representatives, you're using AI to move, you know, based on the degree of anger of a customer that it perceives to the most experienced customer service representative. So there's a huge opportunity set going forward.
What about, I mean, this is one issue in this market, right? A huge driver has been AI for the last couple of years. The other issue is inflation, the consumer, and the Fed. You expect cuts still, but not as many, I imagine, as you would have last year.
No, you know, Matt, I came into this year expecting 3 cuts. I thought it was ridiculous when the market was pricing 6 to 7 based on the data. But even now, I've scaled that back. I think we can reasonably expect a first cut in December. And from all of the Fed speak that we've heard lately, I think that seems likely, given that we need to see a continued downward trend after the bad data from the first quarter. But the Fed clearly has an easing bias. I do not think we're going to get a rate hike. I think that's taken off the table. And so because the backdrop is still one of rate cuts coming, it's a when, not an if situation, I think that provides some tailwinds to the market and gives you a little bit of more breathing room with respect to valuations and concerns that may have existed there. But the economy remains in a good place, and you know, we never should have expected inflation to come down in a linear fashion, and there's going to be bumps along the road.
Well, and the Fed obviously is going to choose, if it has to choose between a weak labor market and resilient inflation, it's going to add jobs. Are you concerned about the consumer right now?
No, I think all of the calls, the persistent calls for the demise of the American consumer have been off base over the past 2 years.
But maybe a weakening, right? We see higher net worth consumers stepping down to Walmart. Target is having a problem with home furnishings and appliances. Maybe not completely offset by its online sales. So brick and mortar stores are in trouble.
Yeah, it's a great point, Matt. And weakening of the consumer is okay, or at least more of a reticence to continue to spend on stuff and maybe only on some of their core goods. But you hear from some of the more, I'll say, specialized retailers, some of the luxury retailers continue to do well. So there's pockets of the consumer that are still spending. And as long as you have a good jobs market, which we do, people's wallets are going to be open. So to me, as an investor, the opportunity set really lies in finding the switching patterns of the consumer, finding where the next opportunity is, and leaning into that going forward. So Target, I think, shows that differentiation, selectivity in this market really, really matter. And I think that's an exciting opportunity to deploy capital into the winners going forward.
Yeah, I think, as long as companies continue to do well on the earnings picture, they're going to need employees, especially if the top line expands, right? But net income is where the rubber meets the road, and we've seen that expand 3 quarters in a row. How confident are you that earnings will continue to expand this year?
I am fairly confident we're going to see earnings continue to expand. And the reason for that is you're seeing a bottoming or an inflection of earnings growth across a much wider breadth of sectors. So financials are finally contributing positively to earnings growth. And it's not just insurance, it's banks, it's your financial services companies. You're seeing industrial start to bottom. Really, Boeing's been the drag on the industrial complex, but you're seeing good strength there. Materials look like they're bottoming. You're seeing utilities pick up. So across the board, you're getting kind of that inflection point that tech had last year. And I think that can propel the market higher, especially as the tailwinds from artificial intelligence and the demand for that also continues to propel information technology earnings as well.
So a broadening out of the market here in the U.S., and we've seen a broadening of markets across the globe as well, whereas previously the U.S. was a clear winner. It looks like others may do well. Do you invest internationally at this point?
Matt, we do. And I've been talking to clients a lot lately about building better balance in portfolios. So that includes leaning into the expanding breadth in the U.S., but importantly, it's looking overseas, because I think a lot of investors are underweight to both international developed and emerging markets. And there's been a great opportunity set start to expand. Global growth surprised to the upside, and you've seen really good strength from European financials. The periphery is finally starting to do better. You're seeing fund flows positive for the first time in years moving into Europe. Japan is finally moving out of deflation, so Japanese banks are an area I think look very, very attractive to lean into that theme. And then you've got elections in India coming up in 2 weeks, and I think that's another emerging market where there's such tremendous long-term secular growth tailwinds that can continue to grow the market over there. So there's a lot of, I'd say, really positive opportunities overseas where valuation is nowhere near as much of a concern as it is here in the U.S.
Matt, great to catch up with you. Don't be a stranger. Matt Orton there, coming to us from Raymond James, where he is the chief market strategist. Joining us now with a look at the stocks moving ahead of the opening bell today, here's Abigail Doolittle. Abby?
Matt, we have some big decliners to take a look at, starting out with the shares of Target. Certainly not that Target feeling right now. In fact, we're looking at the possibility of the first time in 6 quarters of this stock dropping on quarterly results. In fact, it seems very likely, given the fact that the stock right now heading to its worst day in 2 years. Their adjusted earnings number missed, and same-store sales or comp sales declined 3.7% as consumers are holding off on certain discretionary items. Lululemon down 4.3% on the news that their departure, that their chief product officer, Sun Chow, has departed the company. That person will not be replaced. And one analyst saying that this adds to the wall of worry relative to Lululemon. And then we would be remiss if we did not take a look at the stock du jour, maybe the stock of the year. Nvidia up 0.4% ahead of that all-important, possibly binary event after the bell. Matt, the options are pointing to the possibility of an 11% move up or down.
Wow. Okay. Excellent to have that detail from you, Abigail. We're going to check back in with you later in the program. Coming up right now, investors waiting for the Fed to begin its cutting cycle.
In the absence of significant weakening in the labor market, I need to see several more months of good inflation data before I would be comfortable supporting and easing in the stance of monetary policy.
We'll look ahead to today's all-important Fed Minutes next. This is Bloomberg.
This economy has been incredibly resilient, stronger than I expected, and I've been really pleased by how fast inflation has come down in spite of that.
But I think it's a little too soon to determine where inflation necessarily is going. Base case, I do think we're going to have inflation come down, but I think it's going to take longer.
I think this is a moment when, or a period when patience really matters. It's going to take longer for us to see the extent of progress that I think is going to be necessary to change our policy stance.
Frankly, we're not taking a big risk by doing that because so far the labor market remains very healthy.
Fed officials reinforcing a higher for longer message. Investors will be looking for a rate cut clues when the minutes from the Fed's last policy meeting are out this afternoon. Joining us with more is Bloomberg's Liz McCormick. She covers fixed income for us. And Liz, obviously, this is very important to the fixed income market. How many cuts is the market pricing in now?
Yeah, so the market is pricing in less than 2 full quarter-point cuts right now, Matt. You know, it's kind of dialed it back. Last week when we had that better-than-expected CPI release, we were kind of pretty locked at 2 cuts. Now it's come back a little, like all those clips that your folks laid out nicely from the Fed officials that we've heard in the last week. They've been very clear that they can wait. There's no hurry, especially Governor Waller, you know, that talk at the podium he had when he was saying, I need to see several months of kind of basically better inflation prints. So I think that's kind of given the market pause a little bit. So, you know, they've dialed back a little, but it's still flirting around, you know, almost 2, but not quite. Yeah.
Here's a hypothetical. What if they don't see several months of disinflation, but they do see real weakness start to come through in the labor market? Which way would the Fed tilt?
Well, that's what I think is a good point, because what I'd like to see a little bit in the minutes, because Chairman Powell at the press conference after the last meeting, which is the one we'll get the minutes from, talked about, he was pushed from several reporters and questions like kind of what's the rubric, what will cause you to cut? And he said, one, if inflation keeps falling as they want through this year. And then the other is getting to what you said, that he said, if I see we see an unexpected weakening of the labor market. So I think you're right, Matt. Like, we want to hear in the minutes, like, what else did they say about that? You know, how much weakening of the labor market? You know, so yeah, if inflation kind of stays maybe here or a little bit lower, but the unemployment rate keeps rising. Yeah, that's what I'm hoping to maybe garner a little bit from the minutes. Like, how many folks were leaning on that side? What do they have to say? Because yeah, that could drive it as well. We haven't seen, like people say, we're seeing cracks, but it's not cracked. You know, we're seeing some signs. So the next jobs data, as always, is going to be important.
All right, Liz, thanks very much for that. Liz McCormick from Bloomberg News. She covers fixed income for us. Now, headlines crossing on Anglo American. It has already stated it's going to spin off its De Beers business in order to try and fend off a takeover proposal from BHP Billiton. BHP making a further proposal and Anglo rejecting the latest proposal as well and extending the deadline. The shares were already trading below the BHP bid, but Anglo again saying it's confident in its standalone future prospects and it will continue to defend against BHP takeover offers. Let's switch gear now to the world of politics. The latest Bloomberg Morning Consult poll shows half of swing state voters believe there will be violence around the November election. Bloomberg's Annmarie Hordern joins us with more. That's a very broad term, violence. What does that actually mean?
Well, I think there is a lot of concern, not just about protests, but violence, given the fact that we did have the January 6th moment when the Congress went to go certify the election, and then there was an insurrection on the Capitol. I would, though, look outside, though, bird's eye view, where this poll is going. Trump is still leading, but we do see Biden making up some of the ground. It is the tightest, Matt, when it comes to a key belt for Biden, the blue wall, states that really he has to win if he wants to win the election. Michigan, Pennsylvania, Wisconsin. And in these 3 battleground states, the candidates are separated by no more than 2 percentage points. This is really critical here, and this is how tight this race is.
What is President Biden going to do to try and shore up, percentage points in these polls? Because he's clearly behind former President Donald Trump.
Well, I think one thing you can see, and I was reading some of the open-ended response of the survey, where respondents can just write in things they've heard or seen about the candidates. I saw people write in things about Racine, Wisconsin. He was here for AI, things like that. He's going to be spending a lot of time and a lot of money in these 3 states, which we've already seen. He was recently in Wisconsin. The other night he was giving a speech in Detroit. He's been back and forth in Pennsylvania talking about trade and tariffs, trying to get into those blue workers' psyche and concerns they have potentially about jobs and manufacturing going overseas. Something else we've seen the campaign do is really have a split screen when it comes to Biden versus Trump. And potentially that is actually starting to work, because something else we've seen in the respondents is that a lot of individuals, and you ask them open-ended, what have you heard, seen about the former president, they'll talk about his trial, the negative news surrounding the hush money trial. And that potentially could put a damper on his polling.
He's got now about a week before the jury starts to deliberate, and I imagine he'll probably be doing some campaigning here in New York during that time. Annmarie, thanks very much. Bloomberg's Annmarie Hordern covers all things politics for us, and she anchors Bloomberg Surveillance every morning. Coming up, Eric Freedman of U.S. Bank joins us around the opening bell as we look ahead to Nvidia earnings. This is Bloomberg. Breaking news just moments ago, Anglo American rejected the latest BHP offer and is extending the deadline. Bloomberg's Alex Steele joins us now for more. So, Alex, I mean, obviously, Anglo American is like throwing out the family jewels to try and get BHP to back off. What's BHP going to do to make it more attractive?
Well, that's really the question. What Anglo did do is they extended the deadline for talks. So today at noon, the agreement between the two of them to maybe continue talks would end. And they extended that now to May 29th. However, they still don't like the deal. This is the second deal that BHP has put for Anglo American. The issue is that the deal is complicated. They want Anglo American to spin off all its South African assets first and then agree to the takeover. Now, Anglo American does not like that idea. They think it's too complicated and obviously undervalues the company. And Anglo is proposing its own restructuring as well. And that is also, guess what, spinning off some of their South African assets like De Beers. Now, BHP, the idea is that they might just walk away. If nothing goes forward and there are no more talks, it seems like they're willing to walk away. That potentially they're saying we have enough copper assets. This would be super nice, but you know what? We don't need this. But at the end of the day, this is all about copper and getting as much copper growth as possible.
Yeah, I was going to ask. I mean, copper is obviously king with these record prices. Diamonds is another story. Does De Beers really matter anymore?
I mean, probably to De Beers it does. I guess it depends on what kind of company you want to be. I mean, Anglo American is also willing to spin off those assets unto itself to try and woo its own shareholders to not accept the BHP deal, but accept Anglo American's management. And the issue is a lot of shareholders actually own both shares. So the argument is that they would kind of probably like an ownership stake in BHP under this combined company. So they're trying to still fend them off at the end of the day.
All right, complicated but fascinating. Alex, you're the best to explain it. Bloomberg's Alex Steele, thanks so much for joining us. Coming up, we'll talk to Eric Freedman of U.S. Bank Asset Management Group at the opening bell. This is Bloomberg. This is the countdown to the open. I'm Matt Miller, moments away from the start of trading on a day when everybody is looking forward to the closing bell because Nvidia earnings come out then. Today, we have futures mixed ahead of the opening bell after another fresh record high on the S&P 500 yesterday. Let's take a look at some of the other assets we're following for you this morning. Other than stocks, the euro right now trading at 108.39, the 10-year at 4.44, and NYMEX crude down another $1 at $77.70. One stock to watch at the open this morning came out with its earnings before the bell. Target, sales declining again for the retailer as it remains cautious about discretionary spending. Abigail Doolittle has more on this. Abby, what is it, the fourth consecutive quarterly drop for sales?
Yes, it is, Matt, and it's investors clearly not liking it with this stock down at this point 10%, the worst day since November of 2022. But it's interesting because the last 5 quarters into this quarter, the stock had a positive reaction. So this is the first time that we're seeing a decline in 6 quarters after results, and it had to do with that adjusted earnings miss. And to your point on sales, comp sales declined 3.7% for the quarter through early May. Now, this was in line. Most analysts are saying that this is in line, but the color coming from the company, as you know, talking about a little bit of weakness relative to home items along with appliances, really weighing on the shares, especially also given the recent report last week from Walmart, where a lot of folks were flocking to Walmart for their deals, not really hearing about that around Target. So at this point, the stock down 9.7%. Investors really not liking these results at all. That Target feeling gone.
Even the frequency high frequency categories like grocery shopping dipped during the last quarter, and that's typically where you see like a Walmart continue to do well. So have you been to Target lately?
You know, it's funny, Matt. I have not been in a Target recently, and I used to go quite frankly. Part of that might be being in the city, but I was recently near a Target, and I did not have the feeling to go in. So perhaps other U.S. consumers are feeling the same way.
All right. We always like to know the anecdotal. Abby, thanks very much. Abigail Doolittle there on Target. Watch retailers today. We're going to stick with them. TJX boosting its annual profit forecast. Urban Outfitters topping sales estimates, but shares of those edging lower at the moment as well. Simone Foxman joins us with a roundup of the retailers. Simone?
Yeah, Matt, we're trying to get a sense of exactly what is happening to the consumer and sort of a mixed picture in some of these earnings coming out today. TJ Maxx shares set for potentially their highest close ever after kind of a mixed report here, raising its profit guidance for the fiscal year, but seeing comparable sales that were slightly lower than analyst expectations, up 3% year on year. The estimate was 3.4%, and the sales projections for the fiscal year also slightly light, just slightly under expectations. For Urban Outfitters, we're seeing shares sinking as another set of mixed results, these for different reasons. Anthropologie and Free People sales, comp sales up double digits on a year-on-year basis, but still a lot of concerns about the namesake Urban Outfitters brand. Although those were able to offset in this particular quarter, it wasn't the results everyone was hoping for. We did get a few signs here about what is next. TJX talking about a good start to the second quarter. Urban Outfitters mentioning that consumer demand was robust for spring and summer. But I think there's also a cautionary tale here coming out of the likes of Lululemon. This had really been the darling last year when shares rose about 60%, but now we're watching a pretty steep decline there after the company's chief product officer set to leave and not be replaced. We get first quarter results out June 5th, but perhaps a suggestion here that spark, that extra uniqueness is really what's needed to gain an edge in this market. And now we're looking at shares down over 40% this year, Matt.
I don't know why you need a chief product officer. It's just super tight yoga pants, right? Is that not all they do?
Hey, there's something special about the way those yoga pants fit, and they've really been able to dominate that. I mean, I love Lululemon. I have their products. They're really special. Can they keep doing it without that chief product officer? I don't know.
I guess that's the issue. Simone, thanks very much. Simone Foxman there on some more retailers that we're watching in today's trade. Let's turn, though, now to electric vehicles. Tesla losing ground in Europe with sales slumping to a 15-month low, a sluggish start to the second quarter for Elon Musk. They're still making a ton of vehicles. Ed, are they selling all of them? Ed Ludlow joining us, from Bloomberg Technology.
Not selling as many at the start of the second quarter in Europe as they have done in recent quarters and years. The stock's down more than 2%. It's the biggest points drag on the NASDAQ 100 after the open. It's based on data from the Automobile Manufacturers Association in Europe. So they registered just shy of 14,000 new EVs in Europe in the month of April. That is the lowest level since January of 2023. So you have to go back some distance. Remember also the context that on the most recent earnings call, Elon Musk said that going into the second quarter and the rest of the year, all of the challenges of the first quarter, higher rates, competition from plug-in hybrids, was starting to ease a little bit. Well, the data doesn't necessarily show that. Europe is facing all of the kind of same things in the EV market that we have here in North America. Leading Nordic countries have really scaled back on the incentives. While there are many more models on offer on continental Europe at different price points, you do see names like Volkswagen pivot as well to plug-in hybrids, much like some of the OEMs in America are doing. And so you have a direct competition now between BEV and plug-in hybrid, and that does seem to be impacting registrations. So this is one data point in time, but it's worth paying attention to and extrapolating over the course of the year as we track the market incumbent Tesla.
Does Europe have the threat of a Chinese EV? I mean, we have essentially limited that threat here in the U.S. with massive protectionist tariffs. In Europe, is it possible that BYD could sell its $10,000 Seagull?
Yeah, much more possible. And, if you think about the conversation on some of the names like BYD or NIO, NIO has a limited footprint in continental Europe. One thing I was reflecting on recently as well is like when the Biden administration almost quadrupled the tariffs on Chinese-built EVs in this country, I was like, well, how many Chinese-built EVs can you actually buy in America? The answer is like there's only 4 models in very small volumes, but Polestar, as an example, manufactures its cars in Europe. There is, again, a much more domestic industry in Europe where the OEMs, particularly the Germans, but also the French, right, offer a number of EVs that we have no visibility on. And so they have a much more competitive market anyway, meaning that the attraction of a Chinese-built or a Chinese model EV is not sort of the same threat that perhaps it is here in this country.
Ed, thanks very much. Ed Ludlow there, anchors Bloomberg Technology. Definitely tune into that program every day at 11 a.m. Turning now to the housing market and home builders, specifically Toll Brothers, raising its full-year outlook as the luxury builder reported stronger than expected orders. Katie Greifeld is here with more on Toll Brothers. Katie?
Matt, home builders are still high. You can see that in these results from Toll Brothers. Interestingly, the stock is lower right now. We're going to get to that in a minute, but let's go through some of the numbers right now, because for the 3 months through April, you had purchase contracts rising 30% from the same period a year earlier, managing to slightly beat estimates. Then you take a look at the outlook, and you had Toll Brothers boosting its full-year fiscal deliveries guidance between 10,400 to 10,800. That is up from their previous forecast from 10,000 to 10,500 units. So when you think about Toll Brothers, they often cater to more affluent buyers who are more likely to be paying in cash. And you think about the effect of higher interest rates, that means that Toll Brothers' demand is a little bit insulated from that. The company also said that in addition to that profile, its strategy of including, quote, more affordable luxury properties and also boosting its supply of spec homes is helping to increase its market share. And actually on the call just a few minutes ago, you had executives saying that 50% of sales are spec homes right now, actually, and that the long-term average for specs will be 40 to 50%. So a really interesting dynamic developing there. And just quickly on shares, currently down about 3%. Citi did note that you had lower inventory turns rather, and higher debt levels relative to their peers. But it's important to note that the shares are about 100% higher over the past year. So definitely a high bar there.
Absolutely. Katie, thanks very much for that. Katie Greifeld is going to go into the other studio, and she's going to anchor the Baby 10 in just about 20 minutes from now. Joining us to talk about markets further is Eric Freedman, CIO of U.S. Bank Asset Management Group, the asset management arm of the 5th biggest bank in America. Eric, great to have you here with us. Let me ask you, first of all, about how important Nvidia earnings are. Is it right for us to be so focused on this one company amidst this, massive bull market?
Yeah, man, I think it is important to be focused on it. If you look at the ecosystem, if you will, everything from the previous segment, you emphasized utilities, you talked about the business to business trends within technology spend. That's really been a theme, a very durable theme for the last couple of years, and we still think there's legs to it. So if you think about whether it's that company with 20% of its sales to one captive customer, again, that probably broadens out over time, but that just speaks to how much demand there is for that technology. So we do think it's right to focus on it. There's, of course, a lot of other things happening in the world, but it's clear the focus for the day.
In terms of the broadening of the market, how quickly do you see that happening? Where do you see the most evidence of broadening out from the Magnificent Seven?
Yeah, Matt, I think it's something, you and I are both Grateful Dead fans, and it's like, that great song, The 11. There are actually 11 subsectors of the S&P 500 now participating in the uptrend, which is a good thing. So to your point, there's some level of diminishing activity across lower income consumers. We have to really pay attention to that. A lot of the chatter we're hearing from retailers, again, earnings this morning, also some of the overnight action in Europe and Asia, does suggest that at the margin, we're seeing some slowdown of the marginal consumer spend. So we have to pay attention to that. We also have to keep in mind, though, that this economic growth is still really on the back of still positive wages versus inflation. It probably doesn't feel that way to most consumers, but real wage growth is still positive. Should we see that reverse, we get more concerned. We think that probably, dampens, if you will, the 11 broadening out. But for now, we still think there's momentum. We still think there's an opportunity for consumers to keep spending. And that business to business tech spend theme, we think endures.
I'm glad you mentioned the dead because it brings up another one of the big issues for this market, and that is inflation. Tickets to see them at the Sphere, I'm seeing $1,000 prices. Fish tickets were even more. How concerned are you about the lack of disinflation and the resultant lack of Fed cuts?
Yeah, I think, the Sphere recreated Barton Hall from Cornell University, which is a pretty tough ticket not to purchase. So that's probably a little idiosyncratic. But to your point, Matt, this is an environment where inflation and price pressures continue to be an issue. You're starting to see some pushback on that, though. Think about what you've heard from retailers and the clear bias from consumers seeking more value in their day-to-day living, but perhaps are willing to pay up for experiences. That's a theme that we think continues. Again, it's not just the revenge travel coming out of COVID, but people do want to live in the moment. People do want to pay up, if you will, for travel. Again, we have to see how, in fact, what kind of staying power that theme has. But that is something that divergence between day-to-day living versus the more experiential base that people are willing to pay up for, we still think that works. So, obviously the Fed and what happens with the back half of this year with the political landscape clearly in focus. But for now, we still think this is a decent environment for consumer spend.
I definitely need a miracle to get down to Las Vegas. Eric Freedman, what are you doing in your portfolios at U.S. Bank Asset Management right now? I mean, you're moving some big money around, right? $400, $500, $600 billion. Where are you focused?
Yeah, the biggest thing that we have on right now incrementally is that in April, during what I guess we can't really call it a massive dip, Matt, but there was still some level of a downturn in both equity prices and commodities. We actually bought that dip. And so we do think that the commodity bias towards upside surprises is still there. Clearly, days like today when crude's off, that does, we think, represent likely a buying opportunity. But we think that China in particular, as a export-laden economy, they're trying to run the old playbook of obviously pushing exports out as fast as they can. That will be inflationary. We think that if there is a push towards tariffs, that will also be inflationary. We also think that, again, with respect to the consumer demand trends, with some upside risk to things like hydrocarbons and also things, Matt, that you just don't get in corporate earnings. If you want to get exposure to a broadening basket of commodities, you're generally not going to get that in the corporate earnings sphere. So we think owning commodities makes sense on more of a tactical basis. We also think that equal-weighted S&P, which has been the, let's call it the lagging stepchild of the market for some time, we think it's time to get involved. There's a decent inherent yield in that category, but also you have less refinancing risk. Small cap companies in a rising interest rate environment, if we do get that risk upside to rates, will have a trouble refinancing. And so we think that owning equal-weighted S&P is a good way for clients to get exposure to the large cap equity space in the U.S. market.
Eric, great having you on the program. Thanks so much for joining us. Eric Freedman there from U.S. Bank Asset Management coming to us out of Chapel Hill. Coming up, preparing private equity for higher rates.
A lot of firms prepared themselves for higher interest rates by terming out their debt during the pandemic. The sensitivity is just not what it used to be, and that means that it needs more time before we achieve the goal.
We're going to discuss next with Pierre-Antoine de Selancy of 17 Capital, private credit versus syndicated loans. This is Bloomberg. us now is Pierre-Antoine de Selancy, co-founder and managing partner of 17 Capital, a private credit manager specializing in loans to private equity, net asset value financing. Great to have you here, Pierre-Antoine. Thanks so much for joining us. Tell us about the market that you're in, because even though we talk about private equity here a lot, I've been to Super Return a bunch of times in Berlin. I haven't heard the term NAV loans very often. So what exactly is it?
So net asset value loans are loans to investors in private equity. And by and large, these are the funds that hold companies and the managers of these funds. And they use leverage to improve performance for their investors.
And how big has that market gotten now? I mean, it's not a very old market.
No, it's a market that started 15 years ago and that really started to increase exponentially in the last 3-4 years. And looking at a market that's potentially 100 billion and growing to 700 billion in the next 7 years. The entire private equity industry and the buyout market is $2.8 trillion of net asset value. That's the value reported to investors every quarter. So that's a deep market. There's a lot of room for growth for the leverage on that specific market.
So, you know, last year private equity was a big story, mainly because of the private credit aspect coming into a lot of those firms. Now banks have really come back with lending for leveraged buyouts. How do leveraged buyouts look to you in 2024?
I think these are really exciting times. If you look at the way the market, the private equity industry developed over the last 10 years, it's been a very exciting environment because the interest rates were very low. And now the environment is a bit more difficult, a bit more complicated. And you see the difference between the good operators and those who were only benefiting from the environment. So you can separate, you know, the good from the weak ones. And people have to focus a lot more on being efficient on the operations point of view, making the companies better. So it's really an exciting time for the private equity industry.
I mean, I would expect, as interest rates rise, that, you know, leveraged loans would be harder to get, more expensive, more difficult to make money on, and yet, you know, there's so many trillions of dollars in private equity. Has that number grown this year?
So the volume of leveraged loan issued in the first quarter is more than half of the whole of last year. So you see confidence coming back. But yes, the higher...
More than half of the entirety of last year in the first quarter alone.
Yes. So big return of confidence. I think it's just making the job of private equity investors a bit more difficult, which is also making it more interesting. As an investor, you have to choose where you're going to... As an investor in private equity funds, you have probably between 1,800 and 1,900 funds open for you to invest in any day of the week. And you need to choose the best managers, and then you sign with them for another 10 to 12 years. So the industry is under a lot of pressure to do the right thing and provide the better returns for the investors. But it's more difficult today than it was 5 years ago.
Where do you see the biggest opportunity, the best opportunities? I mean, if you're looking at the U.S. or Europe or Asia, are there spots that look more attractive?
Well, we definitely see more appetite in the U.S. and more confidence in this part of the world. And then you have some sectors which continue to thrive. I'm thinking specifically about of software and the healthcare industry, which attract a lot of capital these days.
What about artificial intelligence? I have to ask because today we get Nvidia earnings. And if you look at the chart of Nvidia or a lot of AI, I looked at super microcomputer today, and it was like a hockey stick. So is AI huge as well in your business?
I think in our business, not quite yet. I think there's a lot of people looking at what it could be and what value it could bring to investors. But I think we operate in a buyout space more than the venture capital or the growth space. And in the buyout, I think a lot of companies are looking at it, looking at how they could create more value for the shareholders. But it's still at curiosity level and more than implementation.
And how much does the Fed matter to you? I mean, rates apparently don't have as much of an effect as I would have thought, right? We're a lot higher than we were 2 years ago. Does it matter if they cut once or twice? Does it matter if they even raise once?
It matters usually because it changes the cost of capital for people buying private companies. So it matters usually, and it's going to impact the value of the privately held companies. It's going to impact their liquidity, how easy it is to sell them or buy new ones. So it's a huge impact on the industry.
But it's clearly not holding back leveraged loans if the volume is in the first quarter already more than half of what it was last year.
Yeah, it's coming back. Last year was a substantially lower number than the previous year. So it is coming back, which is good. We see confidence back in the market, and we like to see that. But we're not completely back to the level of 2021.
Pierre-Antoine, great having you in here. Thanks so much.
Thank you very
fascinating
much.
market. Pierre-Antoine de Selancy of 17 Capital. Coming up, the market-moving events you need to be watching today. That's next in our trading diary. This is Bloomberg. Time now for the trading diary. What you need to be watching this week. The FOMC minutes coming at 2 p.m. Eastern. Very important to see how the Fed thought about this most recent data, followed by Nvidia earnings after the closing bell, an earnings report that literally everybody who's invested in equities is going to be watching. Thursday, we get initial jobless claims as well as PMIs for the United States of America. Plus, Atlanta Fed President Raphael Bostic speaks. And then finally, on Friday, we'll get University of Michigan sentiment. So we'll see what the consumer thinks of this economy. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.